We're going to be taking questions from some of our listeners that sent in questions through Ask Nate at Retirement Rescue Radio. And Josh is going to read some of those questions, and I'm going to go ahead and answer them. So, Josh, what do we got today?
Michael says, I have our retirement savings spread out between my 401k, 2 IRAs, a Roth, and several mutual funds that I purchased with after-tax dollars. Which account should I start withdrawing from first?
Great question. First off, Michael, let me congratulate you for having so much tax diversification. Because first off, a lot of advisors will talk about diversification among your assets, but we hear not enough about tax diversification as well, especially with all the stimulus packages that we've had here recently. A lot of people figure that taxes have got to go up to pay for all of this. And so if you've got more tax diversification, now you have more options on where to pull your money from in retirement. And all those different areas that you mentioned, Michael, the 401k, the IRAs, the Roths, the after tax, they're all taxed just a little bit differently. And so on which one that you should start withdrawing from first, without knowing your entire situation, I can't really say yet, but what I can do is give some examples of where you might think, what you might think about when you're answering this question. The first off is, when are you going to retire? Like, how old will you be when you retire? If you are still fairly young, say you're still within your 60s and even the early 60s, right? And you have not claimed Social Security yet, well, there may be the opportunity to possibly convert some of that 401k or IRA money into a Roth at the low tax brackets that we're in right now. And that could save you a boatload of taxes down the road, because now all that money is going to grow tax-free instead of you're going to be taxed on it later, when you're starting to take your required minimum distributions. And so that could be a way. Also, with those taxable accounts, or excuse me, after tax dollars, when you take those out, depending on what tax bracket you're in, if you're, say, married filing jointly, you can make over $100,000 in a year. And of course, you got to subtract your standard deduction and stuff off of that. So gross, you can gross about $100,000 a year, a little north of that, and still not be in the 22% tax bracket. Well, if you have long-term capital gains inside those non-qualified after-tax accounts, you might be able to realize some of those gains without having to pay any tax on them. And so it could be advantageous to maybe realize some of those gains in some of your highly appreciated positions without having to pay tax. But once again, it's just a matter of knowing where you are in your tax map, really, is like, what bracket are you going to be in? And so we like to figure out, based off of the different life experiences, life transitions that you have, where are you going to be at on your tax map, right? Are you going to retire before your spouse? Are you both retiring at the same time? Because if they're still working, that could play a part into when to take from these different funds as well. But first, look, I'll go back again to saying I'm glad that you have so many different areas, because now that does offer a heck of a lot of opportunity there.
Yeah, taxes.
Josh, anything to add to that?
Taxes sometimes seem a little bit out of our control as far as how much we might have to pay, but we like to try to take as much into consideration to where we can limit our exposure on the things we can't control, but then do as much as we can to those things that we can control. Mm-hmm. And tax rates are one thing we can't control, but our exposure to them is something that we can kind of control.
Well said. Well said.
So, and we don't want our exposure up for a vote every 2 years.
No, exactly. So you get it. I know that, and that's one of the reasons I love tax-free. So if you look at the tax continuum, you get your tax deferred, then you get your taxable is first, and then tax deferred, tax-free, and then you've got estate tax-free as well. But I'm trying to think, where was I going with that? I don't remember where I was going with that.
I don't know. I think that train kind of derailed, maybe.
Something, yeah. Just the fact that you have different places that you can pull money from. Oh, yeah. So if tax rates go up in the future, if you have a tax-free chunk, well, guess what? If tax rates even double, 2 times 0 is still 0. And so if you have that tax-free chunk, getting stuff moved into there now at the low tax rates that we're at, that could be even a bigger impact on your future money than you think. So that's definitely a good thing to consider. As always, guys, if you want more confidence in your retirement, our contact information, our calendar link is going to be in the description. So don't forget to smash the subscribe button, hit that notification bell so that you can be notified every single week when we get new content going on. We also have another YouTube channel for our podcast called Retirement Rescue Radio, where we also dive into a lot of topics very deeply. We do that long format, sometimes half an hour to an hour is what some of these can be. And so once again, guys, appreciate you sticking around here. Join us next week, same time, for some more content to give you the information that you need to empower you to live the retirement that you deserve. Take care.